Hi, good morning to all. Today we are here discussed our subject financial derivatives deals with the chapter 3 forwards and futures. Our topic is about the settlement of futures and short selling. Before going to the settlement of futures, we discuss what is futures. Futures are derivative financial contracts obligating the buyer to purchase an asset or the seller to sell an asset at a predetermined future date and set price. Futures are used to hedge the price movement of the underlying asset to help prevent losses from unfavorable price changes. Next, we move our topic settlement of futures. Settlement is an act of closing the contract. It relates to the manner in which the obligation in a contract is honored. Futures can be settled in one of the following three ways. They are physical delivery, cash settlement, and offsetting position. We discussed each of them. First one, physical delivery. The underlying assets of a contract is delivered by the seller to the future exchanges and by the future exchanges to the buyer and payment by the buyer. Physical delivery is common with commodities and bonds. Physical delivery occurs very rarely. So, the physical delivery essentially means that the delivery of goods to a contracted buyer. In the financial contracts, physical delivery is a term for the contract specification that the financial asset is delivered on a specific delivery date. This term is usually used in investments most often than while trading futures. Many future contracts do not reach physical delivery because the asset is traded away before the financial contract matures. Physical delivery also happens when the contract is carried to its delivery date and the original financial assets are delivered to the original buyer specified in contract. Next is cash settlement. All future contracts are cash settled. Example, through the exchange of cash. This is mostly used for settling stock indices futures. On the expiry of settlement period, the future exchanges sets the settlement prices equal to the spot price of the asset on that day. Thus, cash settlement future contracts are settled at a spot price. As per the recent rule, the stock futures will be cash settled. In practice, there are two types of cash settlement for futures. They are daily market to market settlement and final settlement. Daily market to market settlement already been discussed. In the final settlement, on the expiry date of the future contracts, after the close of the hours, the clearinghouse marks all positions of a clearing member to the final statement price and the resulting profit or loss is settled in cash. So, the cash settlement is a settlement option frequently used in trading of future contracts, which are the expedient date. The underlying asset are not physically delivered, while only the difference is being paid by either of the party depending on the market rate at the point of time. It is more convenient and preferred method of settlement as it does not require to take a physical position in any trade. This method is offsetting position. It's very common and popular method of settlement as compared to the above two methods. Offsetting is a process of carrying forward the transactions by changing sides. To be more clearly, the initial buyer liquidates his position by selling a similar future contract and the initial seller goes for buying an identical contract. Thus, offsetting is done through revising trade. It revises existing open position. After these trades are executed and reported to the clearinghouse, both traders' obligations are executed on the books of the clearinghouse and on the exchange members. Thus, in the offsetting position, a trader takes an equivalent but opposite position to reduce the net position to zero. The purpose of taking an offsetting position is to limit or eliminate liabilities. Offsetting is common as a strategy across equities and derivative contracts. So we move on to another topic, short selling. Simply means shorting. Reverse cash and carry arbitrage can also be implemented by people who do not own the asset. Such arbitrages must borrow the asset from someone else before they can sell it. In many cases, large institutions are able to borrow and sell securities that they do not own. Thus, the process is known as short selling or simply shorting. Thus, shorting refers to sell the assets in which are not owned by sellers and buying them back at a future later date. And this is done with the hope that the price of an asset would be go down. The short selling is an investment or trading strategy that speculates on decline in stocks or other security prices. Traders may use short selling as a speculation, and investors or portfolio managers may use it as an hedge against the downside risk of a long position in the same security or a related one. Short selling occurs where an investor borrows on security and sells it on an open market, planning to buy it back later for less money. Short sellers bet on and profit from a drop in the security prices. This can be concentrated with long investors who want the price to go up. So the short selling has an highest risk reward ratio. It can be offer big profits, but losses can be mount quickly and infinitely due to margin calls. So in short, in this video we discussed about the settlement of futures. They are physical delivery, cash settlement, offsetting position. Another topic, short selling. Short selling is an investment or trading strategy that speculates on the decline in stock or any other security prices. So I hope you understood these topics. Thank you.